Welcome everyone, this is Nick, and today's presentation is all about financial ratios. As a business professionals, it is important to have a strong understanding of financial ratios and how they can be used to evaluate a company's financial performance and position. Financial ratios can provide valuable insights into a company's liquidity, solvency, efficiency, and profitability, and they can be used to compare a company to its industry peers, to the market as a whole, or to its own historical performance. So, without further ado, these are the types of financial ratios. Let's talk about the different categories of it. There are several types of financial ratios, including liquidity ratios, solvency ratios, efficiency ratios, and profitability ratios. The first one is liquidity ratios measure a company's ability to pay its short-term obligations, such as the current ratio, which is calculated by dividing current assets by current liabilities. Next one is the solvency ratio, which measures the company's ability to meet its long-term debt obligations, such as the debt-to-equity ratio, which is calculated by dividing total debt by total equity. The third one is equity ratio, measures how well a company is using its assets and resources, such as the inventory turnover ratio, which is calculated by dividing the cost of goods sold by average inventory. And last one is profitability mesh ratios, which measure a company's ability to generate profits, such as the return of assets or ROA, which is calculated by dividing net income by total assets. Now that we've covered the different categories of financial ratios, let's talk about how to interpret them. So, interpreting financial ratios can be challenging as there is no set threshold that determines whether a ratio is good or bad. Instead, it is important to consider the context in which the ratio is being used, such as the industry in which the company operates and the company's own historical performance. Next is it is also important to keep in mind the limitations of financial ratios. They are based on historical data and may not accurately predict the future performance. Additionally, different ratios, excuse me, may be more or less relevant depending on the specific circumstances of the company. Despite of these limitations, financial ratios can still be very useful in evaluating a company's financial health. So let's talk about how they can be used in decision making. Financial ratios can be used in a variety of ways, such as to evaluate a company's financial health, to identify potential investments, or to assess the risk of lending money to a borrower. For example, a potential investor might use financial ratios to evaluate a company's risk profile and determine whether it is a good fit for their portfolio. Similarly, a lender might use financial ratios to decide whether to extend credit to a borrower, taking into account the borrower's ability to repay the loan. In conclusion, financial ratios are a valuable tool for evaluating a company's financial performance and position. They can be used in a variety of contexts to make informed financial decisions. And that's all. I hope you learned something today, and thank you for joining me. And I encourage you to continue learning about financial ratios and how they can be used in your own financial decision making. Again, this is Nick, an account executive in Pearl Lemon Crib. See you and good day.